Dear friends, welcome to the fourth video of the Intelligent Investor series, where we analyze every chapter of the book to extract maximum value. Warren Buffett has called this the best investing book ever written, so every serious investor should understand it in depth. Today, we analyze chapter 3, where Graham walks us through market history, not just what happened, but why it matters. These patterns repeat, and understanding them can save you from disasters or help you profit from them. Before we start, subscribe to the channel so you don't miss any video in this series, and if you are finding value in this deep dive approach, give it a like. It helps others discover it and shows me you want more content like this. Now let's examine what market history teaches us. On page 65, Benjamin Graham writes, "Prudence suggests that he have an adequate idea of the stock market history, in terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times." In other words, Graham is saying every investor must understand market cycles and the relationship between stock prices, earnings, and dividends. Why? Because when you understand these historical patterns, you can identify both the dangers and opportunities at any given moment. So, in this chapter, Graham walks us through a century of stock market data and extracts timeless lessons that still apply today. Let's dive in. On page 67, Graham writes the following. The reader will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924 and shows, for the most part, a series of rather similar market cycles lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in the 1929 with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%. Hence, the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposite, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. Let's break down what this historical diagram truly means. Graham noticed three distinct market patterns, each roughly covering a quarter of a century. The low growth era from 1900s to 1924. For 25 years, the annual advance was only about 3%. This was a modest, almost tedious return characterized by regular, short cycles. It certainly didn't create massive public excitement. The Great Volatility era from 1924 to 1949. This was a financial roller coaster. It included the speculative New Era bull market that peaked in 1929, followed by the catastrophic crash, the Great Depression, and World War II. Over this entire 25-year period, the annual advance was dismal, 1.5%. Think about that for a second. For half a century, from 1900s to 1949, stocks had either negligible or downright frightening returns. Naturally, as Graham notes, the public had no enthusiasm at all for common stocks. They were forgotten, viewed as too risky. Then the greatest bull market from 1949 to 1970. This is where the law of opposites prove its worth. Graham points out, because the public had lost all interest in stocks, the time was ripe for the intelligent investor to step in. And what happened next? The market delivered the greatest bull market in our history up to that point. For 2 decades, stocks soared with an average compounded return of 11%, and that's before you even add the average 3.5% dividend yield. By the mid-60s to early 70s, those annual returns were spiking to 14%. This spectacular performance created a new, dangerous psychological trap. The public, who hated stocks in 1949, were now convinced that this double-digit return was the new normal. And that, my friends, is why Graham had to step in with a major warning about the market level in 1972. It shows the cycle was about to turn again. Graham writes, "These 14 and better returns were documented in 1963 and later in a much publicized study. It created a natural satisfaction on Wall Street with such fine achievements and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone." Graham spotted something dangerous happening. Investors who had watched the market rise for 25 years now believed it would last forever. Today, psychologists have a name for this trap: recency bias. Recency bias is our simple, powerful tendency to believe that what happened recently will keep happening. We give too much weight to the newest, most spectacular data and forget the long-term history. The fascinating part is that while psychologists only began to formally define this bias in the 60s and 70s, Graham recognized this human flaw much earlier. He knew from his market experience that a long stretch of marvelous results creates a dangerous conviction. Graham, writing in 1972, is warning readers that this huge rise can't continue forever. Because prices are so high, they have to be prepared for a crash or significantly lower future profits. He then writes the following: "The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first saw a decrease in earnings and average prices, and no decade after 1900s saw a decrease in average dividends. But the rates of growth in all 3 categories are quite variable." Why does Graham bring up these decade figures right here? After exposing the recency bias caused by the spectacular short-term price returns of the 50s and 60s, Graham directs our attention back to the long-term decade-by-decade averages. Look at the full picture. When you smooth out the emotional price swings, business fundamentals, earnings, and dividends show persistent, steady, long-term growth. No decade after 1900 showed a decrease in average dividends. This proves stocks are worth owning. The underlying businesses are solid and growing. But here is the key. Stock prices swing wildly, driven by emotion, while business fundamentals grow slowly and steadily. This gap is everything. Don't let enthusiasm trick you into paying crazy prices during booms. Don't let panic scare you away during crashes. Those wild swings create dangers when prices are too high and opportunities when prices are too low. Stay invested, but always pay attention to price. To help us do exactly that, Graham provides a historical table showing stock prices along earnings and dividends, and most importantly, the PE ratio that ties them together. If you don't know what the PE ratio is, here's a quick reminder in simple terms. The price-to-earning ratio is how many dollars you have to pay right now for every dollar the company earned last year. Let's see what he concludes from the table. A striking feature of the table is the change in the price-earnings ratios since World War II. In June 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961, the ratio was 22.9 times. Similarly, the dividend yield of the S&P index had fallen from over 7% in 1949 to only 3% in 1961, a contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to 4.5%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. What does this actually mean? Let me put this in perspective. In 1949, when nobody wanted stocks, you could buy $1 of company earnings for just $6.30. That's incredibly cheap. Plus, you were getting a 7% dividend yield, meaning for every $100 you invested, companies were paying you $7 per year in cash dividends. But by 1961, after watching stocks soar for over a decade, investors were willing to pay $22.9 for that same $1 of earnings. The dividend yield had collapsed to just 3%. Here is what makes this even more absurd. During this same period, bond yields had almost doubled, from 2.6% to 4.5%. So you could get a safer 4.5% return from bonds, yet investors were accepting just 3% from stocks, which are far riskier. Look at the psychology here. In 1949, stocks were cheap and paid great dividends, but nobody wanted them. By 1961, stocks were expensive and paid tiny dividends, yet everyone wanted to buy them. Why? Because they had been going up. This is the law of opposites again. When everyone hates an asset and it is cheap, the smart investor buys. When everyone loves it and it's expensive, the smart investor is careful. Graham continues. True, the closing price of the DJIA in 1970 was the same as it was 6.5 years earlier, and the much heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. By 1970, the Dow Jones was at the exact same level it had been in 1964, 6.5 years of going nowhere. All that excitement, all that belief that stocks would keep climbing forever, and investors who bought in the early 60s had made nothing. Benjamin Graham wrote this in 1972, trying to warn investors that they are making the exact same mistake again, and in the remaining part of the chapter, he explains what the situation looked like at the moment and what investors should do about it. Now, in this video, we won't dive deep into the specific market conditions of 1972, but what we can do is extract the timeless lessons from Graham's analysis that apply to any market cycle, including today's. In the 1948 market analysis, Graham concluded that the market was undervalued. In 1953, despite a 50% rise in prices, he still believed significant investments could be made. But by 1959, his tone changed dramatically. He wrote, "In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may be perilous because prices are already far too high. But even if this is not the case, the market's momentum is inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every tyro will be guaranteed a large profit on his stock purchases." This is crucial. Graham saw that investors had stopped caring about valuation. They believed no stock was too expensive and that prices would keep rising forever. That illusion led to a 27% decline in the following years, and for some companies like IBM, the fall was far worse, with stock prices dropping by 50%. It is a perfect example of how optimism can quietly turn into overconfidence and how even great companies can be terrible investments if bought at the wrong price. But the danger wasn't limited to overvalued established companies. Graham also warned about a speculative fever in new issues. This period saw a complete debacle in a host of newly launched common stocks of small enterprises, the so-called hot issues, which had been offered to the public at ridiculously high prices and then had been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotation in just a few months. These hot issues were the IPOs of that period. Graham warned that most IPOs appear near market tops when optimism is high and investors are willing to pay almost any price. Investment bankers take advantage of this demand and bring new companies to the market at inflated prices. Soon after, when the enthusiasm disappears, many of these stocks collapse. some losing more than 90% of their value. Now, after reviewing his past analysis, Graham makes a vital admission that should serve as the final takeaway of this chapter. He writes, "Such were our efforts to evaluate former stock market levels. Is there anything we and our readers can learn from them? We consider the market level favorable for investment in 1948 and 1953, but too cautiously in the latter year, dangerous in 1951 and too high in 1964. All of these judgments could be defended even today by adroit arguments, but it is doubtful if they have been as useful as our more pedestrian counsels in favor of a consistent and controlled common stock policy on the one hand, and discouraging endeavors to beat the market or to pick the winners on the other." After walking us through 100 years of data, after correctly identifying dangerous market levels, Graham makes a stunning admission. Even his accurate market forecasts were probably less useful than his simplest advice. What is that simple advice? Maintain a consistent, controlled stock allocation. Don't try to beat the market or pick the next big winner. Think about what Graham is really saying. Yes, he was right about 1959 being dangerous. Yes, he correctly warned about 1964. But constantly trying to time these moments, even successfully, may not serve you better than simply staying disciplined and with a balanced portfolio. The lesson isn't ignore valuation. It's don't let market timing become your strategy. Even correct predictions about market levels can distract you from the fundamentals of sound investing: balance, discipline, and patience. Graham then applies this discipline to the market of 1972. While the market's 3-year PE ratio in 1971 was 18.1, lower than it was in 1963, it was the comparison to bonds that was alarming. This is because the income ratio had completely flipped. In 1948, the stock dividend yield was 5.6% and the bond yield was 2.7%. Stocks yielded twice as much as bonds. By 1971, the bond yield had gone up to 7.6%, while the stock dividend yield was only 3.1%. Safe bonds were now yielding more than twice as much as risky stocks. Graham's final judgment was that this completely cancelled out any apparent bargain in the PE ratio. This led him to conclude that the market was unattractive from the standpoint of conservative investment. He disregarded Wall Street's optimism and warned the investor to prepare for difficult times ahead, either a quick decline or a final speculative fling followed by a more catastrophic collapse. In the end, Graham tells you to stop guessing and turn back to your established, disciplined strategy. History proves that discipline is the only true source of safety and success in the stock market. Graham's final warning was completely correct. The years right after his 1972 analysis led straight into the devastating 1973-1974 stock market crash. The S&P 500 lost nearly 50% of its value by the end of 1974. The investors who had bought stocks during the period of high excitement suffered through the lost decade of the 1970s. Because of the crash and high inflation, those investors saw little to no real growth for about 10 years. This painful outcome proved Graham's main point. When you pay a high price for a stock, you are betting on impossible future growth, and the market will eventually punish that overconfidence. Now let's see what Jason Zweig has to say in the commentary. The first passage I want to share is this. Since the profits that companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. The profits companies can achieve have an upper limit. So if profits have an upper limit, so does the price. And this is a crucial filter before buying any stock. Take Tesla for example. At the time of this recording in October 2025, it had a PE of 251. For investors to reasonably get their money back at this price, Tesla will need to achieve roughly $2 trillion in annual revenue, more than half the entire global automotive industry. Tesla will need to become larger than Walmart, Apple, and Amazon combined. It can happen, but the probability is extremely low. An intelligent investor will not bet on such unlikely outcome. Paying a PE of 251 isn't investing. It's speculating that an extraordinary future will unfold exactly as hoped. And as Graham showed us throughout this chapter, betting on extraordinary outcomes is how investors lose money. On page 85, Zweig also references the Shiller P ratio, created by Yale professor Robert Shiller, who was inspired by Graham's approach. The Shiller P ratio compares today's stock price to the average earnings over the past 10 years, adjusted for inflation. It smooths out temporary booms and busts to show whether stocks are truly expensive or cheap. Shiller research shows that when this ratio goes well above 20, markets usually deliver poor returns over the next decade. When it drops below 10, stocks typically produce strong gains. Look at the historical evidence. In 1929, with a Shiller PE of 22, the next 10 years returned just 0.1%. In 1965, with a Shiller P ratio of 23.7, investors only earned 1 to 3% annually for the next decade. In December 1999, at the peak of the dot-com bubble, the Shiller PE hit an insane 44.2, and the following decade delivered negative returns, with the S&P 500 ending lower in 2009 than where it started in 1999. Where are we now in 2025? The Shiller P ratio now is approximately 40, the second highest point in history, surpassed only by the 1999 dot-com bubble. It is well above the historical average of 17 and deep in dangerous territory. If history is any guide, investors should expect below average, possibly poor returns over the next decade. The lesson is clear. Valuation matters. High prices today mean lower returns tomorrow. So there you have it. Chapter 3's Timeless Lessons. Graham studied a century of market history, teaching us one profound truth. Don't try to predict the market. Build a disciplined strategy and stick to it. In the next video, we will dive into Chapter 4, where Graham starts giving you the exact blueprint, the specific rules, allocations, and strategies you need to implement that disciplined approach we have been discussing. If you found value in this deep analysis, hit that like button. It helps others discover these lessons. And subscribe so you don't miss the next video in the series. We are building something valuable here, one chapter at a time. Thank you very much for watching, and I'll see you in the next video.